Oh. Good morning and welcome, and thank you for joining us. It's great to have you all here on this Foundation Endowment for Impact. You will notice we're using GoToWebinar, which I think we've all decided as speakers is the first time we've used it in 2023. So this might be quite humorous as we go through, but we're going to try and make this snappy and informative today as a session. And with that in mind, I'm going to ask Alessia to move our slides forward as you all come into the room. Just to give you a very quick overview of what we're planning to do today. Nothing surprising in that we'll have a quick welcome and introductions, and we'll close out with some closing remarks. But the main kind of substance of this talk today will be a panel discussion between the experts we have in the room. We will never touch on everything in 60 minutes. Please do feel free to use the chat function that you'll find on the separate control panel to both share your thoughts, your questions for the panel, and we'll try and pick up some of those. And we'll also try and follow up with any questions that we don't get to answer today as well. So please do. We are not going to be doing case studies and PowerPoint presentations. This will be a discussion. But following this event, we will send a recording of this event, plus some links and information on all the panelists to you as well. So we really want this to spark some discussions and connections. And so that's the plan for today over the next 60 minutes. And with that in mind, we're going to snap through some slides. I'm going to ask some of the panelists to join us now. Before I do so, I'd just like to introduce myself. I very rudely started without actually introducing myself. I'm Peter, and for those who I haven't met or don't know, I work on our foundations and philanthropy work here at EVPA, and I also have the most ridiculously long job title in the world looking at this slide. And I'm here with my colleague Alessia, and we're very happy to welcome you on behalf of EVPA. Also to give a quick thanks to partners on this presentation today. Always grateful for the funding and support of the European Union, even despite Brexit, wanting to share the learnings from the UK across Europe. And also to Philanthropy Impact, who are working as our media partner and may have attracted some of you to this event today. Also, in our closing remarks today, we'll also be joined by Hannah from our friends at Philea, with some information around further events that Philea are doing in this space as well. And that's really important to us as we look to try and make a collaborative approach to move, American phrase, but move the needle in this space and get more assets to impact. And now in the first test for our panelists and their use of GoToWebinar, I'm just going to ask Daniela, Simon and Andrew to join us and just do a very quick sort of 60-second introduction and welcome today. So since Daniela popped up quite so well, I'll ask you to start, Daniela, just to say hello.
Hi, good morning, everyone. My name is Daniela. I'm CEO of Snowball Impact Investments. I have a 30-year career, you wouldn't tell, with a background in both investment and impact. And just a quick one on Snowball. Impact investing is all we do. We have a 6-year track record investing for impact, risk, and competitive financial return. We offer investors a highly diversified investment vehicle that stewards capital for the long term. And our impact investments are selected and actively managed to create competitive returns, measure a positive impact. So the themes we invest on are two sort of big themes of social equity and environmental sustainability. And both are interconnected and really important for a just transition. This very, very high diversification in themes and asset classes allows for lower volatility, fewer ups and downs, basically, in value, and helps us to manage risk much better. As an organization, we're fully independent. We are a big corp and also ranked at the top 5% of all B Corps globally for governance, which is what protects our mission. And you can learn more on our website, snowball.im.
Thank you very much. Very smooth, you've done that before. Simon, can I ask you to?
Sure. Hi, I'm Simon Chisholm, Chief Investment Officer at Resonance. Resonance is an impact property fund manager. We were set up 20 years ago now to help channel investment into social enterprise. And in the last decade, we've really focused on a number of kind of pioneering impact property funds that generate returns for investors, but also focus on specific social problems, including homelessness, domestic abuse, and adults with learning disability. And in doing so, we've structured a number of funds, current funds under management around 350 million sterling. And our current homelessness property fund is now raising 300 million to address homelessness across the UK.
Nice, thank you. And last but not least, Andrew.
Good morning, everybody. My name's Andrew Beale. I'm Head of Investor Engagement at, excuse me, Big Society Capital. Big Society Capital was established in 2012, partly funded by dormant UK banking assets, as well as capital from the big four high street banks in the UK. Our mission is to grow the social impact market in the UK. We act as a wholesaler to that market, so we are investors in funds such as the funds run by Simon and his team, and our role is really to help seed and grow and scale emerging fund managers, as well as helping to pivot some of the established fund managers towards more impact. We broadly operate in four main asset classes: social housing. So, as I say, we are investors in Resonance and other social impact housing managers in the UK. We invest in debt and equity for social enterprises, so supplying growth capital to established models to help them to scale up their impact in the UK. We also are involved in social outcome contracts. Maybe we can come back to these in a bit more detail in the questioning, but these are innovative contracts between government and consortia of charities to tackle some of the UK's most difficult social challenges. And finally, we're involved in impact venture, and that's really mostly about working with established players, but also scaling some of those emerging fund managers as well, and just trying to get the market to pivot more towards impact. We listed on the UK stock market the first social impact fund back in December 2020. So that's a share, an investment trust structure listed in the UK market. That's investing in 3 out of those 4 asset class areas, so social housing, debt and equity for social enterprises, and also in social outcome contracts. That's a vehicle that we think is well suited to investors who are coming into this market for the first time, diversified within asset classes, across asset classes, and also offering that low correlation to mainstream markets and low volatility of returns, and an inflation linked return. So yeah, thanks, Peter.
No worries. And so now I have the unfortunate task of, now that you've heard how good the speakers are, I'm now going to put them on hold for 5 minutes while I talk about other stuff, because I have questions for all 3 of them. But we just wanted to take the next sort of 4 minutes to just take through a couple of kind of scene setting slides, just to ensure we're all kind of on the same page before we dive into conversations with our 3 panelists. And so really, it's before we start that, I just wanted to share, we are going to try and make this interactive as we go along, but we decided to avoid the Slido at the start, or the poll at the start, because we thought we'd try and be all innovative and use them later. But we did want to just draw attention to, very simply, who's in the room at the moment. So if I could ask for the slide to just shift along slightly. There we go. So we had, now getting too excited, the slide that we were going to show very briefly was we got a number of interest and engagement in this session. And as of yesterday, just under 200 people had registered to attend. And the element we just wanted to pull out of that is around a third of those were from the foundation sector. And I think that's really important. in that you are all welcome here. Sometimes you see a webinar that says foundations and you kind of think you can't come unless you're a foundation. If we are going to move along these sort of issues that we're talking about today and get more assets into impact, it's going to take a whole ecosystem. So it's great to see that we, alongside the foundations, we also have the service providers and intermediaries in the room as well. So that was just a little moment to say you're all welcome. I'm pleased to encourage you to do use the chat, which thanks to GoToWebinar is on a completely different panel, but you can also reach from the side of your screen using the little orange arrow, and do feel free to enter in the chat and say hello and give an idea of where you're from. And now to speed through the next couple of slides pretty quickly, I just wanted to place this webinar in a wider sense as well. So EVPA, for those of you who don't know, is an impact finance network. The words change, but basically we are not critical of grant making. We think grant making has a huge role to play and is incredibly important in changing society. What we do believe is that there's other tools in the toolbox that might be of use that could actually maximize impact as well. So coming from that collaborative point of view, EVPA is working this year on two specific areas. Number one is the idea of what we're talking about today is, can we get more assets from foundation endowments to be working towards impact? And I'll come on to that in a second. But the way we're doing this is events such as this, and the one we hosted last year with our friends at Endowment Foundation and Van Leer Foundation, to share learnings across Europe, and also then to really build a community that are going to move to action on this. So in the summer, we'll then be hosting a study visit for those that are interested to actually join, see real life examples, and maybe work on a strategy that suits them to move to impact. And then, and you're all welcome to join us in Torino in November of 2023 for our in-person Impact Week, where amongst other things, we're also going to be doing an endowment pledge event. We'll be honest, we haven't exactly planned how this is going to look yet, but what we envisage is a chance for foundations to make a public commitment to moving their endowments to impact strategies. And the reason this is important is not just because we all like a good party and a chance to applaud people, but more importantly, it's to get some visibility on what this community looks like and enable new people to know who to go to and talk to. And that will also be supported throughout the year with some EVPA work on catalytic grant making as well, to kind of work on other toolboxes, but I won't dwell on that in the interest of time. So very quickly to flick through with our smooth coordination on slides to the next slide that I was just going to touch on very quickly. Oh, the tension. The only thing I was going to mention is very simply on the EVPA spectrum, and that's because you're on an impact finance call, so there has to be a spectrum of capital slide. It's kind of the law. But what we're talking about here is very simple, and sorry for patronizing those of you who do know, and glad there's people on the call that won't know. But what we're talking about here is very simply a spectrum where on one side, traditionally you had philanthropy and you're giving money away for social impact with no interest in a financial return. And on the other hand, you had your investments that were all about investment return and no social impact considerations whatsoever. And in the space of the last 20 years, what we've seen, and it was happening before, but it's been formalized, is an idea that both your hands should talk to each other, and rather than just invest to give away, is there a way that investors can actually have a positive social impact while they're generating returns? So coming down from the right-hand side, and whether there's a role for philanthropists and those giving away capital to look at new tools that could actually recycle capital or maximize impact through things like loans to charities and such like that. I'm being very high level. I don't want to get in an argument about terminologies and other reasons for this. But on that big complicated slide, the idea is that the two hands are coming together to clap in the middle at what would be theoretically impact investing, where we're looking at, can we get a social return alongside our financial return? And the role that we're particularly focusing on today is around grant makers and endowed foundations. So those people who are using an investment pool to generate a return to traditionally give that away. And that really is looking in this context at those that might look at mission related investing in one of the red boxes downstairs, which is, could that investment be doing something to move forward your mission while also generating the financial return you need? And social investment, which could be on both sides, whether you're looking to use a tool such as Andrew mentioned and put your shares into a trust that is then using that money as a social investment resource and lending to charities, or whether you're using some of your philanthropic capital in a in a new and innovative way around lending to social enterprises and others. That's a very quick and a very top level discussion. We could spend a whole webinar digging into terms and spectrums, but we're not going to. But I just wanted to place that there so that we're all in somewhere in the same space, and we're very happy to talk more about that in space. And then I'm going to take 30 seconds to finish off. And these are here, and we'll share the slides. It's just to point to the opportunity that we face. So last year, EVPA, GSG, and a number of the national advisory bodies across Europe did the first landscaping study of European direct impact investing market sizing efforts across Europe. And it threw up a lot of really interesting numbers, smaller numbers than some other reports, some real insights where it's coming from. But the one I wanted to really show on both these slides is the space for growth for foundations. So amongst the direct impact investors that were a part of that study, it looked like only 1% of the funding that was available was coming from foundations, which seemed to us quite surprising. And on the second slide, it also showed that foundations were 10% of represented 10% of the market survey size that we were looking at. So there was a disconnect there somewhere for us and an area for growth. We'll share the study, and we're happy to dig further into it. Luckily, the author of the report is actually Alessia, who's my colleague on this talk. So if you have any difficult questions, feel free to direct them to her. But the idea here is that there's a real opportunity for growth. And so that's why we're doing this work. That's why we're doing this presentation. That's why we're looking forward to conversation with real practitioners. And for that, I'm going to hand over to my colleague, Alessia, to take us forward. Thank you very much.
Thank you, Peter. Hello, everyone. And it was nice because at a certain point, I was not even able to see the slides myself. So I was like, okay, let me see how I can move them. Anyway, so I would love now to start with the panel discussion. But before doing that, I would like to ask some questions to our participants, so to the audience. I don't know whether the technology will assist me, but we have a Slido poll, so hopefully you will be able to see it in a minute, okay? So basically the question I would like to ask the audience, and then I will follow up with our panelists, is this one. So since today we really want to focus on foundations and impact investing and the way in which foundations engage in these practices, the idea is that I mean, there might be some challenges looking at your country. Voila, what are the challenges you think? Oh gosh, sorry. Voila. So regulatory for foundations to invest endowment responsibly, either with social purposes or doing mission-related investments. So we have some options, and you have started already voting. Lack of know-how, lack of understanding, lack of resources, but also regulatory limitations, and also fear of not generating financial returns that might affect the capacity for foundations to give grants. And I see people voting. We asked the same question last year when we ran a similar webinar in July. So I also have then the results from last webinar, which is nice because they're pretty different, I would say, from what I see now. So interesting to see. I'll encourage you to still maybe take a few minutes to vote. I see 24 people voting. I think we can do a bit more. And again, you don't need to be a foundation to answer this question. It's really the perception that you have at country level, but also at EU. So maybe I start telling you that last time the option that is now the most voted, so the fear of not generating financial returns, was actually the least voted option, which is pretty funny. So probably it is also due to the different composition of the audience and the different perceptions. We will dig into that afterwards and see stats. And the lack of know-how and lack of understanding, now it's the second one. Second ones together. Lack of know-how was the most voted last time as well. So I think that we can easily say that for the people online now, it's really this fear of not generating financial returns, but lack of know-how is something that is perceived as a limitation for foundations to engage in impact investing. So I will stop sharing. I think you can still continue to vote, and then once we will be sharing the slides after the webinar, as Peter said, we will also include the results of this poll. So I would like now to stop sharing my screen. So let's see. And voila, I can start with my questions to the panelists. So thank you once more, Daniela, Andrew, and Simon, to be here with us. And maybe I'll start asking you the same question. So we know that there is a commitment by foundations to be more engaged into impact investing, probably now more than ever, but still relatively small amounts go into this direction or have been invested into impact funds, as we've seen from the slide that Peter presented. So just 1% of the capital invested in impact funds was coming from foundations. So maybe I start with you, Daniela, and then I continue with Simon and Andrew. Why do you think is this? Is there again a lack of knowledge, lack of resources, regulatory framework? So tell us more, and we can also compare your answer with the results from the poll.
Okay, I think there are two key things. One is, from a lack of knowledge, I think foundations, especially endowed foundations, have a structural issue that is a barrier for them. Usually their board of directors are composed of people who only understand investment or only understand the mission. And unless there is a concerted effort to empower the mission-led trustees, they don't feel they can opine on that side of things. So I think from the foundation side, we have seen great examples of foundations that have included everyone in the conversation. Part of it is Iris Foundation had a process allowing everyone to learn from how they were learning in terms of investing for impact. We know that Barking and Dagenham Giving, they set out with saying, well, actually, we don't necessarily understand investing and we don't understand impact investing. So how can we empower the entire group with the tools to ask the right questions, to understand the products that they're assessing? And so what I would say from a knowledge perspective is from an internal perspective of foundations, make sure that you include, that you speak in plain English rather than all the investment jargon, that you include everyone in the discussion, but also push your investment managers to be clearer, to cut through the jargon, to articulate their offering. So I think that's kind of a know-how thing. There is a lot of resources. Resources are available for learning on the Impact Investment Institute, on the EVPA, on the Impact Management Project, on our websites, the three of us here. There's a lot of resources to learn. So I think sort of the know-how and knowledge can be breached. I think the other barrier is really how the perception of risk, right? And I think if there is a big distortion, I think, between what is perception and what is the reality of the risk of impact investing. So if you look at two ways of seeing risk, so if you look at it from a mission perspective, ask yourself, how would you, trustees and management, feel about the foundation's duty to the mission? If in order to grant, if you have an endowment of £100 million, for example, in order to grant 4 million to good causes, you've invested 100 million in destroying social equity and environmental sustainability. So are you asking the question, what is the quality of my returns? Or because not all returns are created equal. So I think that is, if you look at the risk from a mission perspective, there is a risk of not doing your mission and a risk of reputation. And the second way, forget about mission, you can look at it from a purely financial perspective. If your assets can be invested and generate competitive returns and a positive impact, why not? Isn't it just better investing? So let me expand on this a little bit. About 50 years ago, foundation portfolios have priced in the risk of inflation and permanent loss of capital. And more recently, say the last 10 years, foundations have also awakened to the reputation risk of investing in sin industries. So they started excluding tobacco, armaments, etc. from the portfolios. What only a few have realized, and I think that's why you have that 1% only there, is how the degradation of the environment and social inequality present a risk to the long-term value and profitability of their investments. And so from a purely financial and investment perspective, there is a risk that is not being accounted for in a lot of the foundation's portfolios. So thinking about Snowball last year, for example, which was a manic year for endowments and foundations, we outperformed significantly traditional portfolios. And the reason for that is because many of our impact asset classes are uncorrelated to traditional debt and equity markets and are also inflation linked with real returns over the cycle. To give you an example of stellar performers were forestry, emerging markets lending, sustainable aquaculture, 3 examples of significant outperformance last year. So I think the perception of risk versus the reality of risk is one that foundations should evaluate. And on the know-how, the resources are there. And I think there is an empowering that the foundation needs to feel. And from our side, being super clear and ask, feel free to ask any and every question. There is no stupid question.
Great. I like the end of the answer, and maybe I'll ask Simon and Andrew to comment on what Daniela said. So really sharing what you think are the challenges and the barriers for foundations to get more involved into everything that is related to impact investing, and also if you want to comment on risk, because I think that this is an important component of the discussion. Over to you, Simon, and then Andrew.
Sure. So I completely agree with everything Daniela said about some of those barriers that are specific to foundations. And I guess just to look at Resonance's kind of investor base at the moment, we have about 1/3 of our investor base which are large institutional investors, pension funds, local authorities. About another 1/3 of our investor base who are what you might call impact investment specialists like Big Society Capital and Snowball. But the other 1/3 of our investor base is endowed foundations. But what's interesting is that they probably now represent less than 10% of our assets under management. And therefore you can see that there tends to be a kind of, on average, smaller scale of investment at the minute coming out of endowed foundations. And I think one of the other perspectives to add to what's already been said is that sometimes that's because endowed foundations are allocating out of an impact carve-out. And if that's the only way that they're investing into impact, then that can be a constraint. Obviously, it's a good way to start, and in many cases, it's the right part of the portfolio to do some of the higher risk impact investing out of. But it doesn't actually preclude an endowed foundation from looking at its whole endowment as a potential source for impact investing if it can be done in appropriate ways. So, for example, most big endowments need to allocate into diversified international property investments. Why would they not be looking at whether they could do that impactfully as well? So I think that's possibly one of the challenges that we see, not enough endowed foundations looking at the whole endowment. And I think in terms of resources, there are some fantastic resources available. Again, one of them I would suggest is the Tonic T100 study that's been going for a number of years now, that's looked at big foundations and how they've looked at allocating 100% of their endowment towards impact. Some good learning there. But another is actually a UK institution called Pensions for Purpose, which has allowed the UK pension sector to look at how it can allocate its portfolios into impact. And I think it's really, it makes the point that if you're a pension fund, you absolutely have a fiduciary duty to generate good risk-adjusted returns. But that's not inconsistent with looking at how that can be done impactfully. And I think it might be that that's quite an interesting space for endowed foundations to look into. And it's certainly not exclusive to pension funds. So obviously, I think, for a European perspective, EVPA is exactly the right place to be looking at this, but those are a couple of other kind of different international perspectives as well. I think, so just to finish on one final point on that, I think if you were to ask me what's the barrier for the endowment to be allocated, it's often consultants, because when you look at the entire endowment, there are lots of consultants involved in how that's done. And I think our simple suggestion is that if you ask your consultants to go and look at impact investing and specific impact investments, that's often the best catalyst to getting something to happen. Because sometimes they will only move when they're asked to.
Thank you, Simon. And of course, it's always good to have friends on the panel so they can promote your organization. But thank you for citing the tonic study, because when it's about 100%, I mean, I think that we still refer to, should I move my 5%, my 10%, when there is something to read about the 100% movement. This is a great source of information. And I've seen that Peter started to share all the links into the chat, so for the attendees to access these resources. And I'll move to Andrew so he can also share his perspective with us.
Yeah, I mean, I'd echo everything that Daniela and Simon has said, and it's certainly our experience as we've been looking to develop social impact investing in the UK, that it's those impact carve-outs that have been really, really important in terms of helping to develop some of these really high impact models. But it is now a function of scale. So the investments that the endowments have made alongside us, they're frequent, but they're in small size because they've come from those carve-outs. And the challenge for all of us really is to help endowments on this journey towards looking at whole portfolio investment. And there's some great case studies now of foundations that are leading the way on this. Guy's and St Thomas's, I would name check at this point. They've been extremely innovative in the space. They're now talking about using the foundation in an integrated fashion to help to seed, to grow, and then ultimately to scale some of these impact investments. Very sophisticated way of looking at the portfolio. Again, as Daniela said, and as Simon mentioned, using impact investments in the portfolio as a diversifier. All of the experience that we've had in social impact investing in the UK tells us that the asset class is low volatility and low correlation relative to everything else that is sitting in people's portfolios. And Daniela was talking about returns last year. It's really clear through a period of great stress that these impact investments have actually continued to deliver. So, adding that to a portfolio, and if you're thinking about a portfolio in terms of trying to optimize, risk, return, and impact, you can build a portfolio that provides a far more optimal mix of all three. And maybe there may be parts of the portfolio where you're generating higher return, but it's that low correlation, it's that diversification benefit that really makes these investments stack up in the portfolio. I completely echo what Daniela and Simon have said around education. One of the key pieces of our work is really trying to help trustees come up the curve in terms of understanding impact investment. Number of schemes that we're involved in. The Association of Charitable Foundations in the UK has partnered with the Impact Investing Institute to run a program now where trustees can come and learn about impact investing. So both financial trustees getting a better understanding of how they can integrate impact into their thinking, and also those more impact orientated trustees getting the knowledge to be able to have far more constructive conversations with their colleagues on investment committees, but also with asset managers. And again, as Simon said, consultants, again and again, consultants appear to be the block here. The large consultants are in many cases, holding clients back from looking at this type of investment. And you know, it's an area of work that I think we all need to do more on our side, to really help the consultants to understand that portfolio benefit, to try something a little bit different on behalf of their clients, and to really, you know, build up the case studies, build up the data now to support you know, the benefits actually that impact investing can bring to portfolios. So there are lots of different strands of work here, I think, but it's all about, you know, the industry, I think, making this far more easier to digest, helping people to get up the curve, helping that appreciation of whole portfolio impact, helping people's appreciation of the risk benefits of impact, and really starting to move things forward.
Thank you so much for all these tips. We can close the panel now. No, I'm joking. I still have a few questions, and I've seen that also we received questions, so I will ask them afterwards. I would like to go back to Daniela to ask a concrete example of, I mean, coming from her experience at Snowball. So several charitable foundations have already invested in Snowball. So can you tell us what you have learned, but also what you think these foundations have learned alongside this journey with you?
It's really interesting. I think everything that everybody has said it's totally resonate with our experience. And you know, there are serious investors that have realized that investment priorities have changed in terms of, you know, we can't just keep doing the same things and expect a different result in that sense. And I think everyone in this course probably realized that. And the experience that we've had is that on a learning perspective, it really is a two-way street. So, for example, we regularly have learning events and briefings about not only impact investing in general, but very, you know, transparent about our portfolio, you know, what has worked, what hasn't worked, you know, having deep dives in particular themes, and foundations really appreciate that. We also worked collaboratively with foundations that want to do that. So, for example, we worked with Friends Provident Foundation in selecting public equity managers because they had a really good experience on that. And so we took that experience and together we crafted a program to how we would select amongst various managers for our portfolio. And the experience that we have is that not only foundations are seeing that it's possible to continue to deliver competitive returns with that impact, it means that most of the foundations invested in us have increased their commitments over the last couple of years. So we're very pleased with that. But I would say it is a two-way street. It is about engagement, and it depends on how, you know, how each foundation wants to engage with that process. And I just to say, the foundations that have invested in us are not investing out of their carve out, they are investing out of their endowment. And the sad thing is that it's few and far between. You know, we need much more of those foundations doing things like that. I would say to Andrew's and Simon's point, just to add one thing in terms of our experience as well, that has been really helpful for foundations, and we do that. We ask the foundations that have already invested in us whether they would be happy to speak to another foundation that is thinking about investing or is thinking about their process. And I'll tell you, most of the times those foundations are more than happy to speak to other foundations. So for foundations of, you know, that are listening to this, don't reinvent the wheel, talk to people. Andrew mentioned Guys and St. Thomas, you know, Iris Foundation has published it publicly. Friends Provident has done a public thing on that as well. So engage with your peers and see how they've overcome some of those barriers.
Thank you so much, Danielle. And actually, I would like also to ask Simon and Andrew, because what you said, I mean, sharing successful examples, it's something that we believe will help educate, let's say, decision makers within foundations. And Guy and St. Thomas actually was part of the webinar last year together with the Impact Investing Institute, who put together a guide about this. Peter put the link for the participant in the chat, and we also had Annes Bad Foundation and Banlieu Foundations from continental Europe. So sometimes there is always this comment, yeah, but UK, you can do it because it's UK, but we're also trying to showcase examples that are from continental Europe. So maybe Andrew, Simon, building on what Daniela just shared, do you think there are other ways in which you as organizations that are innovative can help educate actually decision makers apart from what we have already said? Any other suggestions or things that you would like to tell us?
I think part of it, as I mentioned, is to recognize that there are already other parts of the investment space who are investing into impact for good risk-adjusted returns, and I think that gives confidence to this particular subsector of the endowed foundation world that, you know, they're not actually in this case necessarily always having to lead. And, you know, to see pension funds now investing in this way, I think is a very, very strong indicator to break down that prejudice. I mean, I think another angle that we kind of debated is, why is there not more kind of cross-border impact investment happening around Europe? One of the interesting features of our funds is that we have endowed foundations from the UK investing, we have endowed foundations now from the US investing, but not to date endowed foundations from the mainland Europe. And one hypothesis is that there might again be a sense of, well, you know, if our mission is geographically focused, then, you know, does our impact investing have to have exactly the same geographic focus? And I think that's a really interesting question to unpack, because the answer may not be the same. So obviously, if the mission is with a geographic focus, that's absolutely appropriate, and it might be in one's own country or another selection of countries where that mission is being delivered. But when one comes to think about impact investing, firstly, from a portfolio perspective, there may be benefit to greater diversification. If you think about it from an investment perspective, you might want to be more geographically diversified than you might be in your specific mission. But secondly, the returns that come from impact investing can, of course, be used to deliver through the grant making that very focused geographic mission, even if they're not generated in that geography. But I think the final point on that we're really interested in is how, from a pure impact perspective, it can make sense to be invested in other geographies than perhaps your own specific focus geography, just to be able to see some of the data and the learning and the kind of second order effects that come from investing, for example, into homelessness in a different country, how that translates back into your own environment. You know, can it be a source of inspiration? Can it form connections between organizations, between different countries that are addressing these problems in different ways? There is a very interesting kind of impact connectivity that could be happening through a greater degree of cross-border impact investing. But that can rest on a firm foundation of saying this is a good thing to be doing from a portfolio perspective anyway. So that's one of the kind of interesting aspects that I think, you know, EVPA could be looking into.
Yeah, I mean, on the theme of European investors, so the investment trust, actually there is a large European impact investor who has bought into the trust, and I think it's for the sort of reasons that Simon's highlighted there. It's you know, it's new, it's idiosyncratic, i.e. it doesn't correlate to what they're doing elsewhere in the portfolio, so it provides diversification benefits. And I think that's really important. I think the other aspect of this as well is around product. So, you know, quite often the pushback you get is around product, and I think it's really interesting because today you've got three representatives of a spectrum of product that can solve these problems. So, you know, you have Simon, you know, in a, you know, high impact private asset with a, you know, focus on the UK, and if you have the capability to build a portfolio of that type of private asset fund, you know, there are plenty of examples out there to allow you to do that. That does require a degree of specialist knowledge, can be quite labor intensive. So, you know, we have Daniela and myself as representatives of fund managers who will do that work for you. So, you know, if your mandate requires market return, global diversification, then Snowball, you know, is a perfect vehicle to be able to achieve that. And then, you know, for BSC, you know, what we're able to offer with the investment trust is that access, that ease of access. You know, if you can buy a share in the UK, you can buy a share in an investment trust that will give you broad exposure to a range of social impact funds in the UK. So, you know, there are lots of different ways to do this. The products are there to do it. The ability to scale is increasingly now available to investors. So, you know, once you've got over that hurdle of education and understanding, once you can see how this fits into the total portfolio, there really shouldn't be anything holding you back at this point.
Thank you. Yeah, thank you so much, Andrew. I think again, sharing good examples and also explaining that it's possible to do through different ways, using different products and sectors, and also I like the point on cross-border, Simon. And maybe going back to that on this geographical point, there was a question from Anna from Philae, and I think it's the last one that I can ask you before giving back the floor to Peter for conclusion. Philae did also this mapping on national laws in Europe, and the results highlighted some restrictive regulatory environments in Europe in certain countries. You, from the UK, did you experience any restrictions when it comes to working with foundation? There were some restrictions in the past that then you could overcome. There was any law, so any concrete experience from UK that you can share on these barriers, legal barriers?
Well, some years ago, there was a task force here that became the global GSG task force. And on that task force, one of the biggest efforts was to try and unblock some of the barriers that were just regulatory barriers or tax barriers, for example. A very simple example of that was the creation of EIS. So there was a tax incentive in the UK that existed already for investing in venture and early stage organizations, not impact, and to transfer that tax incentive into the impact arena. So you get also that kind of tax benefit from investing in social organizations. So this is one example, but there were several efforts on that front to kind of unblock regulatory burdens, but also structures. I'm sure there's still quite a lot of those barriers, and and there is a barrier, I think, given the growth of this industry, and this is a broader barrier, which is not just UK, the barrier for new funds to come in, and you will require a massive burden of regulation, which is correct as financial services, but at the same time, the funding that you have to put behind it, to start a new fund is quite significant. So that also is a barrier for funds that might be trying to be completely innovative and are smaller. So that's kind of a more broader barrier, and that exists in the UK and elsewhere. I don't know if anybody else has other comments on that.
I guess,
but
I guess another aspect in the UK has been the legal regulatory framework around foundations. So the foundations in the UK are regulated by the Charity Commission, and in some of the Charity Commission regulation, you know, an interpretation historically has been that foundation endowment should be focused on financial returns and nothing else. It was a landmark case last year, led by Luke Fletcher at Bates Wells, which was Butler Sloss versus the Charity Commission, just to try and confirm trustee obligations in relation to the endowment. And it's a really important judgment. I think the full consequences of it are still being debated, but there is, in my mind, a very clear statement in that judgment that charity trustees should be doing exactly what Daniela and Simon were talking about, which is looking at whole portfolio impact. That as a charity trustee, your obligation is to invest in a way that supports your charitable objectives. Now, the case was brought by 2 environmental charities. So the consequence of that is, if you're an environmental charity, you absolutely have to. You have a fiduciary duty. You have an obligation as a trustee to look at the impact of your investments in relation to your charitable objectives. That's really important and brings this whole idea of you know, the reason for a foundation to exist, its purpose, and reflecting that throughout the entire portfolio.
Simon, anything to add? Otherwise, maybe I'll ask the last question, because there's still a few minutes, but go ahead, Simon, if you want to comment.
No, I think that, you know, that's highlighted some of the things that have been specific to endowed foundations in the UK, and I think there's been a parallel process for pension funds to also get comfortable with their ability to allocate into impact, and that isn't inconsistent with their fiduciary duties, you know, to pensioners. Obviously, the best way to demonstrate that is that these have been highly successful investments and have diversified portfolios and have generated good risk-adjusted return. But I think it's also been helpful to stress to, you know, pension boards that actually, by investing into better social outcomes, they are actually reducing their risks in terms of the kind of, you know, the societal risks that flow from, you know, some of these situations deteriorating. So I think there's definitely been progress in the UK on that front as well.
So thank you, Simon, and thank you, Daniel and Andrea. Since we still have few minutes, even though we don't want to focus our attention really on returns, because as also Simon, you just said, we should look at the quality of social outcomes produced, the impact produced, but we received a question on profitable sectors. So Daniela, you mentioned smart agriculture before, but can you tell us maybe what are for you the sectors that might be a bit more profitable, and also what are the returns we are talking about in the space? And maybe last question that is related, do portfolio include investments in developing countries, because we didn't mention these? So maybe a final answer from each of you, and then I'll give the floor to Peter. So Daniela, maybe you, and then again Simon and Andrew.
So our portfolio is super diversified, and again the higher return but also higher risk are on the venture growth private investments, private equity investments, so venture capital, growth capital. And of course, you know, our portfolio is not just that, so that is balanced with other more conservative asset classes and that have a sort of a lower risk, lower return. So it varies on how you compose your portfolio. You know, our strategy, for example, is to have enough diversification to allow for a more stable, less volatile return that is competitive competitive with non-impact portfolios in terms of the return, with an even lower volatility and impact. So to some extent, what's not to like, right? So, but you then go, and for that, you know, on your second question, we are also invested in emerging markets. And one of the asset classes last year that particularly outperformed was emerging markets lending. And so, you know, the diversification allows for this, you know, one performs one year, the other doesn't perform. It reduces the risk overall on any individual manager, individual sector, individual asset class to underperform because of the composition of the portfolio. So, but, you know, to answer your question, I would say, and I think it's probably the experience of all of us here, that the higher return and higher impact asset class is usually on the private side rather than on the public side. And because you have more direct input and more additionality when you're talking about that impact. That being said, of course, then you have a different type of risk. So
Simon and Andrew, thank you, Daniela. I think the buzzword of today is really diversification of the portfolio. So, Andrew, Simon, any final thoughts?
Yes, I mean, obviously we'd love to talk about the impact of the investments that we make, but that's available on our website in our publicly published impact reports. But from a return perspective and from a diversification perspective, I guess my argument would be, although, you know, for example, our funds focus just on property investment and just in the UK, they still achieve a great degree of diversification around the country in terms of different types of stock. And actually, clearly what people are really looking for is good risk-adjusted return. So, you know, to take risk out of the equation is actually really helpful. So that type of property investment, obviously the returns are generated through a rental yield, which in the UK is linked back to a government-backed local housing allowance, which is pegged to market rents and therefore has a kind of correlation with inflation over time, which many investors find to be an attractive income stream. But it also gives exposure to house price growth in the UK, which, you know, over the last 30 years has averaged at about 6% per annum. It obviously goes up and down according to economic cycles, but property is obviously a long-term investment. So, you know, our funds are 10 to 15 years, and over those periods, you know, investors can get exposure to that kind of upside in a kind of economic growth of the UK, as it were.
Yeah, and I mean, you know, just finally from my point of view, it's down to individual investor preference, appetite for risk, need for return. But you know, to Simon's point, it's possible to build a well-diversified portfolio within the UK. So, you know, our investment trust invests across a range of different housing products. You've got debt and equity, which again has different risk return characteristics, and social outcome contracts, where payment is for achieving social outcomes. So in many senses, the ultimate uncorrelated asset class. So yeah, it's all about individual investor preference, and yeah, just I would say as well, you know, we're delighted to talk to investors to sort of discuss these issues, and you know, delighted to answer any questions after the call.
Great. It was amazing to have you there. So again, once more, Daniela, Simon, and Andrew, thank you so much. And as you said, Andrew, we will follow up with questions. We will re-ask you to share your expertise with our community. And now I would like to give the floor to Hannah from Philea, so she can explain us about an upcoming event, and then Peter will close. Thank you once more.
Yeah, thank you. Thank you very much for an inspiring conversation here, really, in this panel. I learned a lot from the three panelists also, and I represent here Philea, which is the Philanthropic Europe Association, and we represent the foundation and philanthropy sector in Europe. We collaborate with EVPA also around just this intersection of impact investing in foundations. And yeah, very happy to also state here that foundations are considering and reviewing how they do their asset allocation. And as I mentioned in the chat and the question I flagged, sometimes it's the regulatory environment, but there's a lot to do on education. There's a lot to do also on bridging the advisory community, indeed the consultants, also to be aware of what foundations can potentially do with their endowments. So we're part of this movement now where foundations are reconsidering a little bit what they do with their asset allocation, the full spectrum of capital. And there's one recent study published by the European Investment Advisory Hub, who is really looking into a mission-related investment of philanthropic capital. And we are organizing an event together with the European Commission, with DG ECFIN, on 7th of March. And I just want to flag that you're very much invited to join the event. You can also send me an email if you don't yet have access to register through the link which is put here on the slide. But this is a session that will be looking into what are potentially some of the stumbling blocks of mission-related investments, of foundations, endowments, and what is needed to provide potentially more enabling environment, and what could be done also in terms of education. So it's really a journey that I think we as the sector and different infrastructure organizations are embarking on, and it's good to know that foundations are already considering also taking a climate lens, for example, on their endowment and asset allocation. Several foundations have signed up for that on a global perspective and a European perspective. So there is move there. And since the pension funds and others are doing it, it's high time, of course, for foundations also to consider reviewing that. So in a nutshell, that was that. Please join the event on 7th of March. And there is a potential also to create some EU tools that could facilitate more philanthropic engagement. And there is the discussion around, in the context of the Social Economy Action Plan, also to do a co-investment facility to co-invest with some of the EU financial instruments developed. So that will be also something to observe and to further exchange upon. Thank you. And back to Peter, I guess.
Yes, that's brilliant. Thank you so much, Hannah, for doing that. And just very briefly, thank you to all the panelists as well. But we want this to be the start of something. An hour isn't long enough, and apologies, we've overrun, but there's just so much content in this, and it was important to us for two things. Number one, that Hannah joins, because sometimes when you're looking at next steps in the European landscape, it can be difficult to know where to go. And so we're trying to collate everything in one place between us to help it make it easy for you guys in foundations to get what you need. Please do join that event on the 7th of March. I think I've got that right. And also, as been mentioned, please do feel free to use the EVPA website, where there's a number of resources, as well as on the FLAIR website. And we've shared the links in the chat. We will also do follow-up to this event with all of the information, a recording of the webinar and relevant links and similar. And then finally, before I let you go, and thank you so much that so many of you have stayed on past the time, we promise to be more timely next time. Just want to take a very brief second to just thank once again to Daniela, Simon and Andrew, and also to our media partner, Philanthropy Impact, and last but not least, the support of the European Union to help us do this. Thank you all very much for your time. I hope it's been worthwhile. We will follow up, but if you have any questions, please do not hesitate to reach out to either of us or to EVPA more widely. Have a lovely rest of the day, and thank you very much for your time.